Welcome back to Investing Talk podcast. Today we're really digging into a pretty fascinating and maybe high-stakes area of the market. We're focusing on BigBear.AI. This is a company right at that crossroads of advanced AI and national security. It makes it really compelling, but yeah, also complex for investors. Our goal here is simple. Try to peel back the layers, financials, strategy, all the recent news, and give you the clearest picture we can without, all the jargon and noise. Before we jump in, though, if you find these discussions valuable, maybe consider subscribing or liking, leaving a comment. Your support genuinely helps us keep doing these deep dives. And hey, if you really like what we do, you can even think about buying us a coffee. It all helps.
It is a really interesting company to look at. They're balancing some truly cutting-edge tech with the very strict demands that come with government work. What's quite interesting is seeing how they actually manage that, trying to scale up these, innovative AI tools within such a specialized high-security world.
Okay, let's try and unpack this whole high-risk, high-reward thing they seem to represent. Last we checked, June 18th, 2025, the stock was around $3.96. So what is it that makes it feel like such a gamble, but also potentially, a big win in this AI defense space?
Well, that label, high risk, high reward, it really does fit. The reward potential is definitely tied to where they sit in the market. AI-powered decision-making, focusing hard on national security, supply chains. And you look at related markets, like, say, autonomous military vehicles. That's projected to just skyrocket, right? From about $5 billion in 2022 to almost $17 billion by 2030. That's nearly an 18% compound annual growth rate. Huge potential there. But for BigBear.AI, it's not just about riding that general wave. It's more about their deep-rooted connections within the U.S. defense agencies. That creates a kind of barrier, a moat, really, that's tough for others to cross. It almost guarantees them a piece of that growth.
Okay, so that's the reward side. What about the risk?
The risk. That comes down to the fact that right now they're not profitable, and on top of that, they're dealing with some ongoing legal headaches. So it's this mix, cutting-edge promise versus some very real practical hurdles they've got to clear.
Right, so booming market, strong government ties, but also unprofitability.
Let's pivot from the big picture to the balance sheet reality. How do their ambitions actually look when you crunch the numbers? They've shown some decent revenue growth, sounds good, but what are the figures really saying?
Looking at the books, yeah, the revenue growth is there. They reported a 24.3% increase in 2024 revenue. That took them to $158.24 million, up from about $127 million the year before. And Q1 of 2025 kept that going. Revenue hit $34.8 million, which was a 5% increase compared to Q1 the previous year. So growth is happening.
Okay, 5% year over year in Q1. But you mentioned costs. That's the flip side. This growth, it's been expensive. The company posted a really substantial net loss in 2024. We're talking $295.55 million. And that negative free cash flow, it's like, imagine a startup just burning through cash. Even if revenue is growing, if you're spending faster than you're earning, it raises serious questions about, long-term survival.
Well, yeah. $295 million loss against $158 million revenue. That's stark.
It is. It means they either need to keep finding more money or cut costs drastically, or both, really.
That's a huge loss. So expanding is one thing, but doing it sustainably, that's another challenge entirely. Now, you mentioned their gross margin showed some improvement. Is that enough to be encouraging, or is it just, getting slightly better at losing money? Does it signal a real path forward?
That's really the core question, isn't it? The gross margin did improve a bit. It went up to nearly 28% in Q1 2025 from about 25% in Q1 2024. So that suggests maybe some better operational efficiency creeping in. That's positive.
Yeah.
But it's still lower than what you see with the big players in tech services.
So better, but not great yet.
Not yet. And the challenge is turning that gross profit into actual net profit. They did make some smart moves with their debt, though. In Q1 2025, they cut long-term debt by $58 million. They did this mainly through converting notes, basically swapping debt for stock.
Okay, so that helps the balance sheet, but potentially adds more shares out there.
Correct. Dilution risk. And they also raised cash, about $64.7 million from exercising warrants. That's like options letting people buy stock at a set price.
So more cash came in, but again, potentially more dilution.
It's often a trade-off. But the result was, as of the end of March 2025, they actually had a small net cash position. about $6.2 million. That's $100.6 million cash against $101.4 million debt. And their debt-to-equity ratio improved, too, down to about 51% from nearly 79% over 5 years. So the capital structure looks healthier.
But the cash burn.
But the cash burn, yes. That negative free cash flow means they're still spending more than they bring in operationally. That's the persistent worry.
It really paints a picture of them walking a financial tightrope.
Okay, so with losses like that, they must have something pretty special, some unique advantages to keep investors interested. What really makes BigBear.AI stand out in this specific, fast-growing defense AI market?
They do have some key strengths. First, as we mentioned, those strong sort of embedded relationships with U.S. defense and intelligence agencies. That's huge. These aren't just single contracts. They provide stable revenue, chances to expand, and frankly, make it really hard for newcomers to compete. It's a big barrier to entry.
Right.
Second, that Pangiam acquisition back in 2024, that really boosted their capabilities in Vision AI. It gave them what many consider one of the most complete edge AI portfolios out there.
Edge AI. Can you quickly explain what that means in this defense context? Why is that so important? Sure. Edge AI basically means the AI processing happens right on the device. Think a drone, a sensor, a computer on the battlefield, not back in some far-off data center. In defense, this is critical. It means faster decisions, less dependence on potentially shaky network connections, and the ability to operate where communication might be jammed or just unavailable.
Okay, so AI right where the action is. Makes sense.
Exactly. And third, don't underestimate their know-how regarding federal procurement. Understanding those processes, the security rules, it's complex. Having that institutional knowledge is another big advantage that keeps competitors at bay. It's not an easy market to just jump into.
Yeah, navigating government contracts is definitely its own skill set. Okay, so we have this mixed bag, growth, but big losses.
Yeah.
Strategic advantages, but financial pressure. How is the market valuing BigBear.AI through all this? And what about the stock's volatility? Sounds like it's probably been a wild ride.
The valuation metrics, well, they definitely reflect the fact that it's not profitable right now. So things like PE ratio just don't apply. But look at price to sales. It's around 7.27 times. That's way above the industry average of about 3.5.
Wow, double the average.
Yeah. And enterprise value to revenue is also high, around 7.15 times, compared to an industry average closer to 3.8. The market cap, about $1.15 billion, also looks pretty high next to their $158 million annual revenue.
So the market is pricing in a lot of future success.
A huge amount. It's like the market is betting BigBear.AI could become, a major player, maybe the Palantir equivalent for defense AI, despite the current red ink. That creates massive pressure each quarter to show progress towards that vision, and it means there's significant risk if they stumble or don't hit those profitability targets.
High hopes, high pressure. What about the stock's actual day-to-day, week-to-week movement? You mentioned volatility.
Extreme volatility is the phrase. Over the last year, it's swung from a low of $1.17 to a high of $10.36. That's a massive range. Right now, it's trading below its 200-day moving average, which is around $4, but it is above its 50-day average of $3.70, so some recent stabilization maybe. Trading volume is high, though, over 113 million shares on average daily. Lots of interest.
And the beta?
The beta is 3.02. That's really high. It basically means the stock moves, on average, about 3 times as much as the overall market, both up and down.
So definitely not for the faint of heart.
Absolutely not. If you don't like big swings in your portfolio, this one could cause some serious anxiety. Technically, the RSI Relative Strength Index is around 53.5. That's pretty neutral territory, not wildly overbought or oversold. But the MACD, another momentum indicator, is below its signal line. That suggests maybe some bearish or negative momentum in the short term, kind of a mixed technical picture.
Support and resistance levels.
Strong support seems to be around $2.39, and the primary resistance level looks like it's up near $9.78. Big gap there.
Okay, we've looked at the numbers, the strategy, but sometimes the real story is in the executive suite or the courtroom, what's been happening internally. Any corporate drama, especially with that CFO leaving recently and those class action suits.
Yes, the human and legal factors are definitely part of the picture here. There have been significant management changes. Julie Peffer left her role as CFO on June 6, 2025. Sean Ricker was appointed as the interim CFO.
An interim CFO. That often signals some uncertainty, doesn't it?
It can, yes. A CFO departure, especially at a company burning cash and facing lawsuits, tends to make investors pay attention. An interim replacement suggests they're maybe figuring out the next step financially or still searching for a permanent fit. On a more routine note, they did hold their annual shareholder meeting in 2025 and got key proposals approved. Standard governance stuff.
And the lawsuits.
Right, the lawsuits. BigBear.AI is facing several class action suits. The core allegations involve potential accounting misstatements around how they treated some convertible notes and claims that their internal accounting review processes weren't up to scratch. The deadline for lead plaintiffs to join was June 10th, 2025, so these are very current legal issues. They could potentially lead to significant settlements down the line.
That is definitely a cloud hanging over them. So how are the professionals, the analysts reacting? And maybe more importantly, what are the insiders doing with their own shares?
Analyst sentiment is currently leaning positive, but cautiously so. The consensus is a moderate buy, based on 4 analysts. 2 have buy ratings, 2 have hold ratings, no sell ratings right now.
Okay, so not overwhelmingly bullish, but not bearish either.
Pretty much. But it's worth noting there have been some recent downgrades, and a few analysts have trimmed their price targets after those accounting issues came to light. So the caution is increasing.
And the insiders, what are they signaling?
Well, insider sentiment looks pretty negative if you go by recent activity. Corporate insiders sold about $152.6 million worth of shares over the last 3 months. That includes sales by some key executives.
$152 million, that's a lot of selling.
It is a significant amount. While there can be many reasons for insiders to sell stock, that volume does tend to raise eyebrows and could suggest maybe limited confidence from management about the company's immediate future prospects.
Okay, looking forward then. What are the key things investors should be watching for? What events could really move the needle for BigBear.AI, short-term and long-term? And let's revisit the biggest risks.
Short term, the next big date is the Q2 2025 earnings release, expected around August 7th. The consensus estimate is for a loss of 0.77 cents per share. How they perform against that, and especially their guidance for the future, will be crucial. Also, any news or developments from those class action lawsuits. A settlement or dismissal could remove a major uncertainty. Yes, potential new government defense contracts. Given their reliance on that sector, any significant wins could really boost sentiment and eventually revenue. Long term, the big thing is probably the full integration of Pangiam. If they can successfully combine those operations and realize the expected synergies, cost savings, cross-selling that could really improve margins, and of course just the continued growth of the overall AI defense market. If that trend continues as expected, and if they keep developing relevant products, their potential market keeps expanding.
Makes sense. Now let's really focus on the risks again. What should listeners be most cautious about here? It seems like there are quite a few potential pitfalls.
There are definitely several layers of risk to consider. First, the company-specific ones, those ongoing losses and the negative cash flow. That just fundamentally questions their long-term sustainability if it continues. The potential financial hit from the class action lawsuits is another big one. Settlements can be costly. Then there's their heavy dependence on government contracts. Any shifts in defense budgets or government policy could directly impact them. It's concentration risk. And that recent CFO change adds a layer of operational uncertainty, at least in the near term.
Okay, those are internal. What about broader risks?
Sector-wise, defense budgets can be volatile. Competition is intense. They're up against huge, well-funded players like Palantir, Booz, Allen Hamilton. Also, AI itself moves incredibly fast. There's always the risk their current tech could be leapfrogged, and evolving AI regulations could add compliance costs.
And the wider economy.
Macro risks matter too. High-growth, non-profitable tech stocks are often very sensitive to rising interest rates. And with that high beta we talked about, BigBear.AI is extra vulnerable to any broad market downturns. Finally, geopolitics. It's a double-edged sword. Increased global tensions could boost defense spending, benefiting them. But high uncertainty can also just spook markets generally.
Okay, that's a comprehensive list of warnings. So let's synthesize this. If you are an investor out there, someone with a high tolerance for risk, a long-term view, and you genuinely believe BigBear.AI can navigate these challenges and eventually hit profitability, what's a potential game plan?
Well, first, understand this is speculative. Our internal rating puts it around a 4 out of 10. It really is best suited for aggressive investors. And think long-term, maybe 2 to 3 years, not short-term trading. There are too many binary events, lawsuit outcomes, big contracts that make short-term moves unpredictable. Plus, the Pangiam integration needs time, operational fixes need time, and the defense AI market growth is a longer story.
What about entry points?
If you're conservative, maybe look for entry points closer to those strong support levels, perhaps in the $2.50 to $3 range. If you're more aggressive playing momentum, the current range of $3.50 to $4 might be considered, but that carries more immediate downside risk.
And assuming someone does take a position, how should they manage the risk? And what kind of upside targets might be reasonable if things go well?
Risk management is critical here. Given the volatility in the binary risks, position sizing should be small, maybe no more than 2% to 3% of your total portfolio value.
Keep it contained.
Definitely. And investors need to actively monitor key developments. Quarterly earnings calls, any news on the lawsuits, major contract announcements, these could be early signals of fundamental shifts, good or bad. As for potential take-profit targets, short term, if things go well, maybe around $5.50. That aligns roughly with the current average analyst price target. Longer term, if they really execute, integrate Pangiam well, improve operations, and capture that market growth, maybe you could see targets in the $7 to $8 range, but that's definitely based on a lot of ifs.
So wrapping this all up, BigBear.AI, it's undeniably got some fascinating tech, a strong foothold in a potentially huge market. But wow, it also comes with some serious baggage and hurdles. This whole discussion really hammers home that even when you're talking about exciting cutting-edge industries like AI and defense, the fundamentals, profitability, cash flow, legal issues, they still matter just as much, maybe more.
It truly does. It highlights why you need to understand not just the big market story, but also the specific risks tied to the company itself and the external pressures that can really change the game for investors.
We've walked through BigBear.AI's story, the growth, the painful losses, the strategic buys, the legal clouds. It leaves you, the listener, with a pretty pointed question. How much risk, real risk, are you willing to stomach for the potential payoff in a very specialized, very dynamic sector like this? Definitely something to think about as you consider your own investment strategy. All right, that's it for this focused analysis. Thanks for tuning in to Investing Talk Podcast, and we will be back soon with another deep dive.